All right, we can get this started. Good afternoon, everyone. My name is Scott Furley. I am the Senior Director of Member and Investor Relations here at the Boulder Chamber. Um, as you probably know, a new Colorado state law has been implemented, necessitating employers with 5 or more employees to offer a retirement plan this year. The Boulder Chamber is taking steps to assist its members by presenting alternative options to the state-managed retirement platform. Through collaboration with Lincoln Financial, a company with a solid A+ rating from both the S&P and Fitch, as well as our trusted fiduciary and third-party administrator partner, Future Plan, the Boulder Chamber is introducing the Multi-Employer Aggregation Program, or MEAP, MEAP. This program can be tailored to the specific needs of each member's company. It's a mouthful for me. Just should have said MEAP. For chamber members who opt for the chamber retirement program, the benefits are numerous. These include streamlined and administration process, relief from fiduciary responsibilities, and the advantage of partnering with these reputable entities that are on the call with me. This program also offers a cost-effective solution with potential eligibility for the state tax credit, effectively making it nearly cost-free for those who qualify. Today, I have the privilege of hosting Johan Zjordrup, the Vice President of Sales of Future Plan, who will dive deeper into the details of this mandate and elaborate on the comprehensive solutions that are available to members of the Boulder Chamber. Also joining us is Kristen Jacobson from First Western Trust. She's the Senior Vice President and Director of Retirement Services, and will also be available to answer any questions you may have. For those of you that are not members on this call and would like to learn more about the Boulder Chamber specifically, I'm going to put my contact information in the chat and would be more than happy to talk with you about Boulder Chamber and the benefits of membership. So with that, I would like to welcome Johan to the call. And so Johan, the floor is yours.
Great. Thank you, Scott. I appreciate that. Everyone, thank you for taking the time. I appreciate the opportunity to speak with you for a little bit. As Scott had mentioned, I am going to go over in depth what the Colorado Secure Savers program is, what that means for you as a business owner, what that means for your employees, as well as alternatives, because the Chamber has built a fantastic alternative that might be a better fit for you than the state program. So just getting going right into this now. Get my screen shared. All right. So the Colorado Secure Savers program, what you need to know. That's what I'll be talking about today. Make sure I get everything going here. So today we are going to go over, first off, just what is the program? What is it? What are the compliance requirements? Are there other options? Are there other things that we can do instead of this state mandate? And a comparative analysis. What are the other options? What are the benefits and drawbacks of each one? As well as who can I turn to for help? We're already kind of starting that. This is a fantastic forum for help for questions initially, as well as this Boulder Chamber MEAP is a fantastic opportunity for you to leverage this program and the state mandate into something for yourself and for your employees. So starting off, what is the Colorado State Secure Savings Program? In Colorado, 40% of the private sector workforce doesn't have any access to a retirement plan through their work. When they did the original estimates and they were putting this plan together, they put it together to mimic the CalSavers plan. CalSavers plan was the state of California plan. And they estimated that with that 40%, there's actually over 1 million employees in the state of Colorado that do not have access to a company-sponsored retirement plan, and they're going to get access through this mandate. So just out of the gate, it's a nice benefit. We're offering access to our employees. We're offering them a little bit of security, and we're offering them a benefit that oftentimes employees don't think that they can even go talk to a financial advisor unless they have a certain amount of assets. So this does open the door for a lot of people. The Colorado Secure Savings Program basically is a portable Roth IRA account. So it's an individual retirement account. It's portable. They can make contributions into the the state CSSP plan from any employer. So you can do it from an employer today. They can leave that employment, go join another company, and it's portable. It moves with them. They don't have to distribute it. The company can just make those contributions into the state plan. The Colorado Secure Savings Act does require participation from all Colorado businesses that meet the following criteria. The first one is businesses that are registered to conduct business in the state of Colorado that have been in operation for 2 or more years. Businesses that have 5 or more employees who have worked for the company for at least 180 days. And businesses that do not currently offer a qualified retirement savings plan. That would be a 401k, a 403b, a simple IRA, a SEP IRA, or a 457b plan. As I go through this, you'll notice there's a couple things that are highlighted in red. That is something I'm going to come back and talk about on the SEP IRA, but we'll come back to that in just a little bit. The original legislation says that Colorado businesses must register with the state based on their employee count by the schedule that I have listed up here on the screen. If you have greater than 50 employees, you have to register by March 15th of 2023, 15 to 49, May 15th of 2023, and 5 to 14, you have to register by June 30th of 2023. Obviously, I think you're all noticing that all of those dates are in the past. Colorado was very aggressive when they put out this schedule. The state of California tried to do this over 18 months. Colorado tried to do this over 6 months. So those are the technical requirements for registration. What the state of Colorado has said, though, is that they do not intend to levy any penalties or do any follow-up on the requirement to participate in the plan or to register with the state until November of 2024. That's not in writing, but that is something that every one of the people that I've talked to at the state of Colorado plan, they have concurred that there will be no penalties assessed until February of 2024. Penalties are for employers that do not participate in the state program, they fail to have a qualified exemption, or they fail to enroll in their employees. The fines can be up to $100 per eligible employee per year, capped at $5,000 per year. Effectively, this is very much like the Affordable Care Act. The idea behind this legislation is we're going to make it cost about the same to not offer your employees a plan and pay the penalty as it would just to offer your employees a plan. So that is kind of the thought process behind the penalties. Recently, almost concurrent with the implementation of the Colorado Secure Savings Act, we have Secure 2.0. That has an impact on the decision on what employers are going to want to do as far as complying with the state mandate. So December 27th, Congress enacted Secure 2.0, a huge piece of legislation, 30,000 some pages. There were 94 provisions regarding employer retirement plans, but today I'm just going to talk about a couple of them. The first one is we enhanced new plan startup credits. So prior to the passage of this act, you could get, as a business owner, the ability to pay for half of your first 3 years of administration and setup cost if you offered a retirement benefit to your employees. With the passage of Secure 2.0, that changed to up to 100%. The way that this works is it's $250 per eligible non-highly compensated employee, up to 100% of the setup costs for the first 3 years. It's capped at $5,000, which you also notice was where the fines were capped. This credit is available to employers with 50 or fewer employees. But if we think about it, if you have 20 employees that are non-highly compensated, then, and that's going to be under $150,000 in compensation in the prior year, then you're going to be getting $250 per 20 employees is going to get you to the $5,000 cap. There was a new credit that was also added to the legislation, which provides employers additional tax credit to offset some of the expense for employer contributions. This is brand new, and this is really exciting for people that are starting new plans. As an employer, you can get a tax credit for the lesser of $1,000 or 100% of the amount of money that you contribute to your employees that make less than $100,000 for the first 5 years of the plan. The first 2 years, it's 100%. The third year, it's 75%. The fourth year, it's 50%. The fifth year, it's 25%. but it is up to $1,000 per employee each year. And this is a tax credit. This is not a write-off. You could always write it off. It was always tax deductible. This is a dollar for dollar credit. The IRS right now is so interested in helping employers set up plans that they are going to pay. They're going to pay you back as an employer up to $1,000 per employee making under $100,000. They're going to pay you back what you give to those employees. I have plan sponsors that are simply making $1,000 contributions to their non-highly compensated employees because the state is going to reimburse them, and it builds an amazing goodwill, and it also builds excitement about the plan. So that's brand new. That is capped at $50,000. So now with $5,000 for the startup credits plus $50,000 available in this employer matching or employer contribution credit, that is $55,000 in available credit. Going back to Secure, the original Secure Act, I always call it 1.0, but it was just Secure. There is also a $500 per year for the first 3 years of a plan credit available if you implement automatic enrollment and automatic increase. And I'll talk about that a little bit more as we move through the process. But these tax credits right now are phenomenal. It has never been a better time to set up a plan than it is right now, which in Colorado is fantastic because now we're also required to set up a plan. So going back to the state plan, what does it have to offer? It is, as I mentioned, a employer deferral Roth IRA. It has automatic enrollment and automatic escalation, meaning that if you have an employee that's eligible, you have, so they've worked for you for 180 days and you've been in business for 2 years. After 30 days, if they have not made an election, if they have not gone to the state website and opted out, you need to automatically enroll them at 5%. So 5% of their pay will come out. It will be automatically sent to the state of Colorado, and it will go into a Roth IRA account. That's going to increase 1% each year up to 8% of their income. So they can recharacterize their contributions as pre-tax, but the initial contribution will always be Roth. They can also opt out, or they can elect a different percentage. Once they make an affirmative election, then we no longer have to worry about the automatic enrollment or the automatic increase. Like I said, employees should be automatically enrolled within 30 days of the initial business registration. So that registration deadline has passed, but obviously a lot of people have not done that registration yet. In the future, after you have registered with the state, if you just choose to do the state plan, it would be within 180 days of hire. So a new hire within 180 days, you would register and automatically enroll them for contributions. This is an employee-only plan. Employer contributions are not allowed. So as a business owner, there's no way for you to make a contribution to your employees. Effectively, you're just giving them access to a Roth IRA that they may or may not have done on their own. When an employee is automatically enrolled in the state plan, their funds are going to be invested in a capital preservation option. It's going to sit there for 30 days to see if the employee actually logs in and does something with their money. If they don't, it's going to be moved from the capital preservation, essentially a cash option, into a target date default option based on their date of birth. So if you're going to retire in 2035, you'll be put in the 2035 default fund. There is no cost to the employer to set up or operate the state plan. The employees are charged a base fee of $22 per year. They pay 5 basis points of their assets to the state of Colorado, and they pay 15 basis points of their assets to the record keeper of the IRA. That's currently Vestwell, as the provider there. There are underlying asset charges, anywhere from 2.5 to 12 basis points, depending on the investment selection. And these asset charges just pay for the administration, basically, of the IRA and the administration of the funds. While there is no out-of-pocket expense for you as a business owner to utilize the state plan, there are some responsibilities that you just do need to know about. So we talked about the registration requirement. Again, not needing to happen immediately, but this will definitely be something that every business that is not does not already have a plan in place or is not registered, you will want to be registered probably before the end of the year so that you're not on the follow-up list for the state fines. The state should have notified any employer that they need to register about 30 days prior to that registration deadline. Again, that was February 15th for employers with 50 or more, April 15 for 15 to 49, and May 30th for 5 to 14. When you do register for the state plan, you need to have your EIN. You need to have the unique access code, which was either sent to you via email or it could have been sent to you hard copy in the mail. Just depends on what information the state has for you. The state's going to want to know your payroll provider's name, the payroll company's schedule. They're going to want your banking information to set up an EIF, an electronic fund transfer, and the latest employee roster. So you're going to need to provide the state with all of your employees, when they were hired, how much they're getting paid, all of those types of things. Every payroll, the employer, that being you, is going to need to update the employee roster, adding new hires, indicating employees who have opted in as the plan goes forward, as well as newly eligible employees who have just reached the age of eligibility. As a business owner, you just need to maintain the records of each deferral election and deferral election change. So when we get to January 1st, when that automatic increase piece kicks in, you know who you have to increase their contribution. Each payroll, as a business owner, you're going to upload the current payroll information and the participating employees information to the Colorado Secure Savings portal, and there will be an EFT taken from your banking account. The automatic increase of the provision I just mentioned happens every year in January. So we've gone over the compliance requirements and the penalties. Registering and enrolling in the program is one way to avoid having to pay the penalties. The other way is to register and certify that you're exempt from the requirements of the Colorado Secure Savings Plan based on the fact that you may already have a qualified plan or the program may not apply to you for other reasons. There are a couple of very unique circumstances where you may not need to comply, but for the most part, it's going to cover all Colorado registered businesses. It has been actually implemented that the state of Colorado has gone out to the Department of Labor, the EFAST website, and they have researched all the employers who have 5500s filed. 5500 is the tax filing form for a IRA or a 401k or a 403b plan, and that way they would identify a certain number of businesses that did not need to register because they've identified they already have a plan in place. It is my recommendation, though, if you did not receive a notification, don't assume that you don't need to comply. The last phone call I was on was with a local company here just down in Castle Rock. And while we were on the phone, they said, no, we've never received that notification. It must not apply to us. By the end of the conversation, they found an old email address that the state of Colorado still had on file and realized that they actually did need to register. So going to the website, clicking on the link, it will help you drive through. You can also call, get on the phone with somebody and ask them if you need to register or if you need to do anything. Right now is a great time to call the state of Colorado. In December, I imagine those phone lines are going to be a little bit slow. Couple things in red here. We talked about the penalties, and I did mention earlier that the state has stated verbally that there will not be any penalties enforced until February of 2024. By rule, by the actual legislation, it says that if you have not registered by the schedule that we looked at before, and you have not automatically enrolled employees 30 days after that registration, you could be subject to fines. That is not what is going to happen, but I just clarify that because that is what it still says on the website. On the other side of the coin, state website does not currently talk about employers who are in the process of setting up a plan for the 2023 year, but the plan is not in place as of the time that they registered. So maybe you don't have a signed document yet, or maybe the plan is going to start on January 1st of 2024. The consensus and what the state is saying right now is, again, there's going to be a period of time to complete plan implementation, but it is not specifically stated on the state website. So just a couple of caveats to be aware of right there. So other options. The first thing I'm going to talk about is IRA-based options. SEPs and Simples are both effectively IRAs. Simple is an acronym. It's a savings incentive match plan for employers. And a SEP is a simplified employer pension. Both of these are IRA plans. In the simple plans, these do allow for pre-tax contributions. It allows an employee to make contributions up to a smaller limit than we would look at in a traditional 401k world, but in a greater amount than you can do with a state plan. With Secure 2.0, effective January 1 of this year, they said that you can do Roth contributions into your simple IRA. That is the law throughout the nation. There is yet to be one single provider that has figured out how to allow Roth contributions in simple IRAs. It's one of those things where the government passed some legislation in a hurry. I think it was because it was right after Christmas and they all wanted to go home. But there's no path to implementation. Just on Monday, the first guidance came out from the IRS on the Secure 2.0 Act, and it said that the requirement for businesses to make all catch-up contributions into retirement plans, Roth, has been delayed for 2 years. That's likely because they haven't figured out how to do Roth contributions in IRAs, and they haven't figured out how record keepers are going to do Roth-only contributions within 401k plans based on prior year contributions or prior year earnings. So that's been kicked down the road. That can's been kicked down the road for 2 years. That's not going to happen anytime soon. Simple IRAs are low-cost plans. They do qualify for the exemption from the state program. So if pre-tax is okay, if the contribution limits are good, it is low cost, and it is going to qualify for the state requirement. Some of the drawbacks, some restricted investment choices. The mutual funds are more expensive because they are individual IRA accounts. So you're not even getting price breaks based on all of the people in the simple IRA plan. It's just based on what your individual balances are. It also, another big drawback is there is no profit sharing functionality. Profit sharing is another piece that we'll talk about in the 401k plan. It gives us some additional options for an employer to leverage their tax position and to develop some loyalty through vesting schedules and things like that within their employees. SEP IRAs. This is the one that I had originally mentioned that was highlighted in red. SEP IRAs are employer contributions only. This is effectively like a profit share, except for it's a very simple profit share. Everybody gets the same percentage, no more than 25%. These are very low-cost plans as well, and they currently do qualify for exemption from the state program. However, when you read the state program and you read their charter and what was the purpose of setting up the Colorado Secure Savings Program to begin with, it was to allow employees to save their earnings for retirement. Since there are no employee contributions, this doesn't really qualify. I think very, very soon, maybe in the next couple of months, maybe in the next 14 months, the state is going to realize that a SEP IRA is a loophole. It's something that could be set up for a business, not funded, and have no ongoing cost. It's basically just an effective way for a business owner to avoid compliance with the state plan. So I do think SEP IRAs will not meet the state requirements no longer than a year from now. So same type of restricted investment choices that we have in the simple, because it is an IRA product as well. Again, we mentioned no employee deferrals are allowed, and it's limited to 25% of eligible compensation, which is the same for everyone, business owners and employees. Some other options: 401ks, 403bs, 457bs. These are a little more robust. These allow for elective deferrals to be made either pre-tax or Roth. Every participant can make that election on their own. We have much higher 402G limits. 402G is the most that somebody can defer into the plan. For 2023, an employee can put $22,500 if they are under age 50, and an additional $7,500 if they are 50 or older. Much more flexible eligibility rules. With a state plan, it was an employee that has worked for you for 180 days. They have to be 18 years old and 180 days of service. That's it. In the SEP and the simple IRAs, it has to do with people that made $5,000 in a prior year. When we're talking about a 401k, 403b, 457b, in this world, we have much more flexible eligibility requirements. The statutory maximum is we can say you have to be 21 years old, you have to have worked for me for a year, and you have to have worked 1,000 hours in that year. And if you did all three of those things, then I'll let you in the plan maybe twice a year, maybe quarterly, maybe monthly. But there's a lot of different ways that we can put this out there. We can really target who we want to offer the plan to. And to me, that's a huge benefit of these more robust plans. There's no point in offering a plan to a 18-year-old kid that works 200 hours a year that has absolutely no interest in the plan. He's just another person that we have to manage the requirements and the compliance requirements to make sure that we're doing everything that we should. In these more robust plans, we can say, gosh, you know what? We're not going to offer it to him because he's not interested. The other piece, just in a 401k by itself, is much broader investment choices and lower expense ratios. We're now taking all of the assets of everyone that's involved in the plan, and we're getting some power of scale. So now instead of just one person's account, it might be 10 people's accounts or 40 people's accounts, however many employees that you have that are participating. That gives us much lower expense ratios, much broader investment choices, and effectively just a better product that we give to our employees for a benefit. We do have the ability to have employer contributions that we can do safe harbor plans. Safe harbor plans are based on back in the early 1980s, doctors and lawyers were putting together plans, and their employees didn't participate, and therefore they would fail some discrimination testing. Safe harbor plans say, "Gosh, you know what? If you're making a really good offer to your employees, we're not going to penalize you as a business owner for your employees not taking you up on a benefit that you're offering." Certain plan designs can be utilized to make sure that business owners can put in $22,500, $30,000 a year. They can match themselves with employer contributions, and they're not going to be penalized by employees that may not be interested. These can be fantastic plans for restaurants, maybe some types of blue collar situations, or on the other side of the coin, uh, very white collar situations where again maybe we just have some people that aren't interested in participating. Um, Traditional plan designs can be managed, so rather than doing a safe harbor, we can put together um, much broader plan designs, but these may require some discrimination testing. Um, I've worked with plans where we have matching schedules where we say, we are going to make a matching contribution, but we're going to cap it if you're highly compensated, and we're going to do 25 cents on the dollar. And really, the amazing thing in these types of plans is sitting down with someone like myself, and I am the person that actually designs all the plans for the Boulder Chamber, sitting down with me and talking about what are your goals? What's the best way for us to get there? How do we design a plan that helps you achieve retention, that draws new people in, that achieves maximum benefit for employers, that achieves tax credits, that achieves compliance with the state program? Whatever your goals are, there's different ways that we can write the plan to get there. Vesting schedules are very powerful. We have to get into this type of plan to have a vesting schedule. This is a fantastic tool for retention. We can say, hey, we're going to give you an employer contribution, but you only get a part of it unless you've been here for a certain number of years. Up to 6 years is how far out we can kick a vesting schedule. And then we also have some really interesting ways that we can determine what contributions we're going to give to employees. We can do that pro rata one where we say, okay, everybody gets the same 3%, or we can do a match. But we can also, in our profit sharing, we can say, we're going to base it on how old you are or how long you've been with the company. If you're close to retirement, maybe we need to give you a higher contribution, a higher percentage of your pay, which usually is where business owners fall. They're amongst the older of the employees. Let's give the business owners a 28% contribution. Let's give the employees a 5% contribution because the business owner has been reinvesting into the business for years. And now they need to take a moment and think, gosh, I need to take care of myself as well. I need to pay myself. So all of these different things, very flexible as far as what that gives, just in general in the 401k, 403b, and 457 place. A quick comparative analysis. These are all the things that we just talked about, and we will provide this deck so that you have this. But looking at the Colorado Secure Savers Program, the simple IRA, I didn't put the SEP on here because I don't think it's going to qualify, so I really wouldn't recommend setting one up at this point, and a 401k. That includes the 403bs as well. They're all at this point effectively the same. But we do get the ability to have that tax credit. We talked about up to, between the tax credit and the employer match credit, up to $55,000 a year in credits that we can get back from the IRS. Add to that the $500 that's available for automatic enrollment. We are allowed to do pre-tax and post-tax contributions, and we have employer matching contributions, employer profit sharing contributions. This is going to give us the best investment options and expense ratios. I would recommend that we do a automatic enrollment in the 401k world. By January 1 of 2025, it is going to be mandated. But we also have now some flexibility. In the state plan, you start at 5, you increase 1% until you get 8. In the requirements from Secure 2.0 say that January 1st of 2025, you have to automatically enroll people at 3% at least and take them up to at least 10%. But I have not written a plan like that yet this year. I either start the automatic enrollment at 6% or I start it at 10%. And there's different reasons for that we can talk about when we talk about plan design, but effectively 6% plus maybe a 3% non-elective or a 3.5% match is going to get an employee to a 9.5% contribution rate. That's going to change their lives. That really makes the retirement plan something that is going to help them retire. That was the number that they always used back in the 80s. You can tell how old I am from my gray hair. But back in the 80s, they always said save at least 9% of your pay in order to have a reasonable retirement. So we're gonna start them off that way if we do a 6% contribution, or we can do 10%. The 10%, the benefit of 10% contribution on an automatic enrollment is we don't have to automatically increase everybody. We're already there. We start at the top and we're at the top. The most important thing about a 10% automatic enrollment is employees are going to make a decision. If you go to somebody and you say, you're eligible for the plan, I need you to tell me what you want to do. If you don't tell me, I'm going to take 10% out of your pay. They're going to tell you what they want you to do. And that's the most important piece. We want our employees to engage, tell us what they want for us to do. This all goes back, this whole automatic enrollment conversation goes back to driver's licenses in Belgium and driver's licenses in the United States. In Belgium, when you get a driver's license, and you flip it over and you have to mark a box on the back that says you do not want to be an organ donor. In the United States, you get your driver's license, you flip it over, and you mark on the back, I do want to be an organ donor. The difference in participation in that program in Belgium and the United States, 93% of Belgian citizens are organ donors. In the United States, 93 are not. So if we kind of force the hand of our employees and say, we're going to need you to make a decision because it's about you and it's about your future and it's about your happiness and your safety and your wealth, and this is how we're going to make them do that. It's a fantastic way to absolutely force that to happen. The last thing that I have on this slide here is with the state of Colorado, a lot of business owners are just not happy with an EFT to the state. So you don't have to do that with the simple IRA or with the 401k plan. So who can I turn to for help? And that's really kind of the crux of what we're talking about here. This presentation is really built about what is the state plan and what am I required to do and what are my options. There's another option that's on the table that the Boulder Chamber has built and given you the access to, and it's an enhanced version of the 401k that we were just talking about. We were talking about the power of scale. We're talking about the ability in a 401k to kind of pool all of your assets with everybody else that works for your company and get better expense ratios, get better service, get more bells and whistles, because in the power of scale, there's more money to be considered. What the Boulder Chamber has done with this Me app is it's now amplified that, and now it's a group of plans. It's a multiple employer aggregation plan. So now you not only get the benefit of the assets that you're putting in the plan as a business owner, you get the benefit of the assets that all of your colleagues and all the other chamber members that are participating are putting into the plan. And that gives us the opportunity to have fiduciary services. We can have 316 fiduciary services, which is where my company acts as a co-fiduciary on the plan. And we sign 5500s and file them with the IRS for you. So that's something that you don't have to do. We can sign distributions and get those out the door so you don't have to stop every time somebody wants to take money out of the plan. There's a 338 fiduciary. There's a company that's engaged just to monitor the investments and make sure that the investments are meeting an investment policy standard, and it's monitored on a quarterly basis. So that takes a lot of liability off of you as a business owner, and it provides some comfort to your employees that they know that they've got this ability to trust in the investments that are out there. We have a group of advisors that are associated with the plan. We have all the bells and whistles that Lincoln Financial has, financial planning tools, calculators. My company, at the end of the day, we're the rules people. Your employees would never really even know that future plan exists, but we're your resource as a business owner, as a plan sponsor, when you have questions and you have compliance questions. We're the ones that are going to, at the beginning of the situation, I'm going to help you design a plan that's going to help you achieve your goals. But after we move forward, my team is going to talk to you every single year and say, is this still the right plan design? Should we make some changes? Or this is what just passed through Congress and it's going to change the way that we have to operate things. There's been a major retirement act of Congress every year for the last 6 years. So there will be some more as they come out. If you take a moment and look at your invitation, there is a link that was in the invitation, and I'm just going to show you where that takes you. It takes us to the boulderchamber.com member services, and this is where you can go. Coming over here to this website, this is the logo for Lincoln Financial, and here's an ability for you to schedule a 15-minute call. This is how we kind of get the plan started. We can talk about your specific company, what pricing is going to look like, what services are going to look like. And then at a certain point, you're going to connect with me again. So I hope you like listening to my voice because we'll probably talk again. But I'll go through and we'll have a really in-depth conversation and talk about what are we trying to do with a plan. And we can help you with a much more robust plan at a much lower cost point because of the me app that the Boulder Chamber has set up. So kind of in a nutshell, and I'll stop right now and see if there's any questions. I don't want to go too far. So does anyone have any questions that they'd like to ask?
Johan, we do have some questions we received through the Q&A section. So we'll do our best to try to answer as many as possible, but also as Johan just mentioned, I added the link to schedule the 15-minute call with our program specialist here in the chat, as well as the side that he's showing right now. But let's go through some questions. And Christine, thank you for joining us. Okay, so first question. Does the chamber plan allow for my own company to determine what retirement plans we offer to our own employees?
That is absolutely correct. Each plan is individually designed, but in the market, we scale them as one plan. But you do have one plan. So you don't have to have the same provisions that your business owner next door has. You get to design if you want a safe harbor, if you want to do a match, or if you don't want to do a match. What your eligibility requirements are. They don't have to be the same across the board. Your plan is your plan. It's just aggregated for costs and for services to make it more effective and give you a little more bang for your buck.
Wonderful. Thank you. I have another question. As an employer, if I do the state plan, I can't contribute, so we will not qualify for the tax credit. But if I join through the chamber, does our company qualify for the state credits?
It does. It absolutely does. Mostly what I'm seeing right now, and I can go through this with you individually, we can have a census and talk about who would be eligible. I can help you calculate exactly what your tax credit can be. But most of the time I'm seeing that, a business with, 15 to 20 employees total is going to have their entire administrative expense be paid by the tax credits. If it's a little bit less, well, then, it's still going to be a much more reasonably priced plan. But I can let you know kind of in that conversation that we have a couple steps down the road, exactly what your credits are going to look like, as well as what the cost is going to look like.
Thank you. Next question. What is the phone number to call to find out if our business needs to register?
I will look that up, and I will have that go out on the follow-up email. I apologize, I don't have that phone number right in front of me.
Great. I'm also making a note to make sure we can follow up on that one. We have one more question, and if anyone else has other questions, please feel free to submit them through the Q&A section. So in this state plan, I can contribute, so no tax credit of up to $50,000.
That's correct. So with the state plan, there's no employer contributions. There's also no cost. And since there's no cost, there's no tax credit. So these tax credits are going to expire as we move forward. Right now, they are set up because for whatever reason in 2022, when this legislation was going through, this was some of the most important legislation that's ever occurred in this 401k, in this defined contribution space. But a lot of these are going to expire as we move forward. The ability for the automatic enrollment. Right now, the automatic enrollment and the automatic um, increase credit is still out there, but it's also mandated. So right now, for the first time in the history of this industry, the IRS has the carrot and the stick out at the same time. So those are going to expire. I would say if a business does not apply and start utilizing those credits no later than 2024, by the time it becomes a mandated piece, because automatic enrollment and automatic increase will be required in all plans in the next 5 years, is my estimate. It is something that has just constantly taken a step further and further and further because it is so important to our government to have people saving for retirement. If you wait until 5 years from now when it is absolutely required for all plans, that credit won't be here. The startup credit, at a certain point, different administrations are going to have different goals. That's going to expire as well. It might go back to 50% or it might go away altogether. And this is the first time that we've ever had the IRS actually offer a credit to reimburse employers for contributions made to employees. So this is an absolute fantastic time to set up a plan because you get to build goodwill and excitement with your employees right off of the bat.
Wonderful, thank you. We don't have any other open questions at the moment, so I'm going to encourage the attendees, if there are any other questions, please add them to the Q&A section. In the meantime, we added the Colorado State number here in the chat, as well as the link to access all this information, as well as the recording of this session will be available by the end of the week here on the link. Okay, we have one more question actually. Does the chamber plan allow for my own company to determine what retirement plans we offer to our own employees, or is it what the chamber plans are?
So another excellent question. As the business owner, you design your own plan. If you choose to use the state plan, you would not use the Boulder Chamber Me app. That would be a separate engagement that you're doing with the state. If you wanted to do a simple IRA, that's not part of the Me app. So that would be something that Kristen might be able to help you out with on an individual basis. However, as soon as you start a plan, whether it's going to be the state plan or it's going to be a simple IRA, that starts the 3-year clock on those tax credits. So a lot of the people that I'm talking to right now are talking to me about, gosh, you know what? It's really time for me to switch. I've outgrown my simple and it's time for me to move into a 401k. I get those tax credits, right? And unfortunately, the answer for them is no, because since they started that simple and there was a cost to implement that simple, that started the clock. If they started their simple 3 years ago, they have utilized all of those tax credits up. So right now, it is such an aggressive goal of the government, the IRS, and the state of Colorado to get these plans in place. I think in most situations, it behooves a business owner to go ahead and move forward with a 401k plan because it's going to get paid for by the state and the IRS at this point.
Johan, I think that they may have been asking if the investment options, a lot of times I hear when people say plans, they mean the investment options. So if that was the intent of the question, the investment options are the same across the board. We have a very nice diversified portfolio, indexed, and some active managers.
I think you're right, Kristen. Thank you for that.
Yeah.
Wonderful. We don't have any other open questions at the moment. Kristen, do you want to offer any closing remarks, or Johan?
No, appreciate everybody joining today. I'm another resource. We are the advisor on the Boulder Chamber plan, so very familiar with and helping with the setup. the MEAP. So if you have questions, please feel free to reach out. I'm at First Western Trust, and Boulder has my contact information. They can send that out as well. Thank you for having me.
Yeah, and then for me, I really appreciate it. I think the team between First Western Trust, Lincoln Financial, and my company Future Plan, we're just really excited to help people navigate these waters and help them make the right decisions. So hopefully there's enough interest that we get to have another conversation, and individually we can talk about how to design a plan to help you.
All right, thank you, Kristen and Johan, for joining us today. Just a reminder that members do qualify for that, and if you're not a member, definitely look into the program, and if it's a fit, definitely connect with us. And then also, just interesting fact, Lincoln Financial has been around since 1905, which is the same year that the chamber started. So we are exactly this 118-year-old organization. So that's just exciting to partner with an organization that has that length of stewardship as well as the chamber. And then, yeah, that is pretty much it. Just thank you for joining us. If you have any questions, there'll be follow-up, as Maya had mentioned, and then also contact information and the landing page where you can find out all that information, and then my contact information if you had any questions about Boulder Chamber membership. So thank you for joining us today, and enjoy the rest of your day.